Doris. I'm here to show you about my stock account. Today my stock account has earned $1,004.48. The US stocks closed lower on Friday as all three major indexes rose more than 1.2% for the week. The Federal Reserve's semi-annual report warned that tightening credit conditions could put pressure on the US economy. So let's first take a look at my account. Right now, the net asset of my account is $966.00 of a gain today, which is a gain of 1.45%. Today, the net asset of my account is $67,425.71. That's QOQ made a gain of 1.88% today, rising to 19.45, and United Natural Gas made a gain of 2.42% to 7.19. Today, the stock market generally closed lower. Nasdaq Composite closed down 0.68%, S&P 500 closed down 0.37%, and the Dow Jones Industrial Average closed down 0.32%. Today, all of the sectors closed lower except for the medical industry. Today, especially the tech industries led to the most loss today, with a loss of more than 1% on average. The S&P 500 posted its fifth straight week of gains, and the Nasdaq rose for its eighth straight week. The Fed skipped the hike this week, but hinted it'll still raise rates twice this year, while investors widely expect the Fed to be nearing completion. Friday is the so-called Four Magic Day, quadruple witching, which is the third week of the last month of each quarter. March, June, September, and December, when all financial derivatives in the U.S. stock market will mature and make a settlement and delivery. On today, traders would significantly adjust their portfolio, causing the U.S. trade volume and creating a more volatile market. Stocks will be closed on next Monday for the Juneteenth holiday. There are a few things worth saying. First, the S&P 500 rose nearly 2.6%, its biggest weekly gain since last March. S&P 500 rose its fifth straight week, its longest winning streak since November 2021. The S&P 500 now has rebounded more than 26% from its near bear market lows. The Nasdaq rose 3.25%, its biggest weekly gain since late March. The Nasdaq posted its eighth straight weekly gains, its longest winning streak since 2019. The Dow Jones Industrial Average rose 1.25% for the week, its third straight week of gains. The S&P 500 entered a technical bull market last week, but Bank of America strategist Michael Hartnett said it was not the start of a big market rally. The strategist said in a report Friday that he did not believe it was the start of a whole new shiny bull market. The current market looks like 2008 or 2000, when Hartnett wrote in the Bank Weekly report on investment flows in various asset classes. After a sharp fall, this week was a week of decisions by several central banks, with the Federal Reserve, the European Central Bank, and the Bank of Japan announcing interest rate decisions. All three central banks acted full in line with market expectations. The Federal Reserve and the Bank of Japan kept interest rate unchanged, with the European Central Bank raising rates by 25 basis points. The Fed's policy decision this week gave investors what they want. Chancellor Bank left interest rate unchanged on Friday after raising the interest rates 10 times in a row. Fed President Richmond, Fed President James Bullard on Friday said that the U.S. inflation remains too high. Although inflation has fallen from its peak, it's still too high. Our target now is looking for 2%. The May CPI, released on Tuesday, showed a 12-month overall CPI of 4.0% and a core CPI of 5.3%. In a way, I think inflation continues because the effect of the pandemic remains with us. While the Fed signals two or more interest rate rises this year, many Wall Street traders and economists believe that the Fed's rate hike cycle may be coming to an end. Economic data also supports this market view. May's Consumer Price Index posted their slowest pace in 2 years earlier this week. The Fed says that tighter credit conditions in the U.S. after several bank failures collapsed in March could put pressure on economic growth, and that the extent to which further tightening of monetary policy will depend on further data releases. In its semi-annual report to Congress on Friday, the Fed said the Federal Open Market Committee will determine the appropriate extent of further policy tightening based on the overall picture of the upcoming data and its impact on the economic activity and inflation prospects to gradually reduce inflation to 2%. The Fed said, to get inflation back to 2%, the economic growth may need to be below trend for some time, and the labor market environment needs to weaken somewhat. The Fed report, published on its website, provides Congress with the latest information on economic and financial development and monetary policy. Mr. Powell will testify to the House Financial Services Committee on June 21st and will speak to the Senate Banking Committee the next day. The report said there is evidence that recent pressures on the banking sector and related concerns about deposit outflow and funding costs have led to a tighter or expected tightening of lending standards in terms of some banks, more than reported tightening without pressure. The FOMC on Wednesday put a pause on the 15-month rate hike cycle, but policymakers expect 2 more this year. The federal funds rate remains in a range of 5 to 5.25%, and the new dot plot shows the Fed's median year-end rate of 5.6%, up from the 5.1% forecast in the previous dot plot. The unemployment remains at 3.7% this year in May. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.